bonds firming up today after a sell-off post-employment, the numbers that were ahead of expectations. Larry Shover joins us for the Friday Bond Check-In, and Managing Director at Exchange Capital Resources. Larry, so what did we learn about the bond market's relationship with Jay Powell this week?
Wow. Okay, well, I think it's like two ways to look at it. You know, you have this whole thing with don't twist, but if you want, I'm not going to do anything about it. Shout all you want, right? And so really yesterday, Powell's poker face translated to the market a shorter journey to normalcy. And you see the Eurodollars today priced in a full hike by December 2022. Big deal. BLS report comes out today, and you see at its very essence, the economic optimism was ratified by the data today. And you combine that with the Fed's reluctance to do anything about keeping lid on rates, and people think, okay, the Roaring 20s, the whole pathway to the Roaring 20s is accelerated. Here we are, and so that's why yields are where they are, and that's why we've had that huge rally in the stock market today.
So, Larry, when we look at this, what is a bigger sort of contributor here? Maybe not a bigger contributor, but what is the contribution and role of bond buying as a force to keep yields contained? We know that the Fed is buying a ton of bonds, but they're not changing the amount they are. So it seems like that should be understood by the market, and it seems one interpretation to your point this week is that there's shouting about potential twist, but no actual twist itself. Joe Bruce Willis from RSM this morning was on the show. He says that they will twist by 1.75%. Do you have thoughts on whether or not the Fed will, or should we take them at face value and wait until we hear more details?
I think the latter is always a safer way to go, although I might believe the former more than the latter. But yeah, fighting the Fed never works out, or it seems like it never does. But the fact is, it was a fascinating 24 hours when you consider what happened yesterday and how the market interpreted that and brought it into its own. But when Powell was indifferent towards rates and towards doing anything, the market didn't like that whatsoever. But then all of a sudden, the BLS report comes out. Now, mind you, there's still 10 million people out of work, and there's still huge amount of unknowns. But you combine that with the reluctance of the Fed doing anything and good data, I think the market just perceived that as that, hey, the journey to normalcy is going to be closer. We're off to the races, to the Roaring 20s once again.
So if Powell hasn't told us, if he hasn't given us numbers, he's being very careful not to give us numbers about what yield he's worried by or what degree of tightening via the stock market might worry him. Larry, should we go with the trend and expect higher yields for now until he's more explicit about buying bonds? Is that really what matters here? I mean, I know that we could have some economic event, but let's just say with probabilities of recovery looking good and probabilities of vaccines looking good, let's just say that there's no economic shock on the way. Do you want to trend with yields higher until he talks about twisting, yield curve controlling, or something along those lines?
I've lost a lot of money in the last few weeks.
Appreciate the transparency, Larry.
Right.
You're not the only one.
I'm probably the best person to talk to. It's been very hard because I do believe that there exists a lot of potential potholes along the way to getting this market and economy and pandemic and fiscal stimulus back to normal. I mean, I think everything has to go right in order for yields to be where they are today. I'm not going to fight the trend right now. I mean, I've fought it already. I've lost enough. And so I'm kind of on the sidelines. I would not be excited to be short bonds here, thinking that yields are going to continue to climb. But if you roll the tape back 2 weeks, I said that 2 weeks ago when yields were 30 basis points lower. So I have a lot of egg on my face. That said, I still do believe we'll see 1%. But I said that last week, the week before, and the week before that, and it's not true. But I just do believe that as wonderful as the news was this morning, there's still a lot of heavy lifting to be done and so many unknowns. Just think of the fiscal stimulus. I mean, is it too much? Is it not enough? Is it just right? The pathway to the pandemic, the fact that there's almost 10 million people out of work still, will that recover? Who knows? And so I mean, it's great to be wrong, I suppose, and see the market rally and all that. But the fact of the matter is, I still do believe that there's too many potholes out there, and it's too easy for yields to go back down.
Larry, the biggest counterpoint I could see to that case for lower yields and those potholes derailing us is that it seems that, at least in language, policy and policymakers have been ready to jump and provide more, that they'll fill in those potholes. I mean, even if we hit them, does it send our car over the rails, or does it just put us on the sidelines? So do you have to kind of have doubt in policymakers to have that bullish bond view that far down?
You know, I think so. And that's a very good point, because yesterday I felt like the first time in a while that the Fed really disappointed, because we all agree that Jerome Powell has been overly dovish and has outdoved the doves all along. And I thought what he did yesterday was outstanding, but it wasn't what the market wanted to hear. And I think the whole push and pull right now is that there's three things. It's habituation of yields, it's apathy, and then correction. Because we do know that the pass-through of the longer yields stay above 1.5%, the more impact it's going to have, the direct flow through to the consumer, to corporate, to housing. And that's the first thing that the data that they look at. And so it's really fascinating to see.
I can go straight to Shana.
What's that?
Hey, sorry, Larry. No, my bad, Larry. I didn't mean to jump in. I want to take it to our next guest in a sec, because I want to keep you. Usually we take a break here, Larry, but I like this conversation. So I want to see, guys, if we can go straight to our next guest here, because I got one more for you, Larry. I mean, this is so important, right? We're wrapping up the week. It's been all about bonds. We're going to talk stocks in a sec, but I want to close out this bond conversation with this. Earlier you said don't fight the Fed, right? And then you said that, well, Powell this week, for the first time, basically let people down. Now, we can all dispute whether or not people should have been expecting twist or anything else.
Yeah.
But if he's going to stick by that, if employment's his number one right now, Larry, not the market, not bonds, then is the new fight the Fed going the other way? Is trying to buy bonds fighting the Fed?
Yeah, well, only because I think yields have gone too far, too fast. And there's that whole push and pull that if yields stay as high as they are, stocks and valuations and earnings and unemployment really need to keep up. And, you know, as an American, I hope that all happens. I hope I'm so wrong. But the fact of the matter is, I mean, I think there's just way too many risks inherent in front of us. Everything has to go perfectly. And so that's why I think that there's a better case for yields to go back down than they are to grind higher without a major correction in the stock market.
Okay. All right, Larry, sticking with the guns, like it, and appreciate, as always, the transparency and how you're trading. That's what we like here. Learning along the way. Thanks, Larry Shover. Great stuff.
Thank you.